If the amount given is less than the current annual exclusion amount, which in 2025 is $19,000, gifts under that amount also don't need to be reported, no matter what they're given for or to whom.
Hello, and welcome to another episode of It Depends, a podcast series brought to you by Hanseman Weeble. You know that if you've ever talked to an accountant, they've told you, well, it depends. This podcast series is for business owners, leaders, operators, accountants, or someone just wanting to learn more about the accounting industry. I'm your host, Clarissa Hoffman. Today we are joined by Helene Downs to talk about trust and estate giving. Thanks for joining us, Helene.
You're welcome. Nice to be here.
Can you tell us a little bit about yourself?
Well, I am a tax partner here at Hanseman Weeble. I do specialize in the trust and estate area, which means that that's my primary focus, although I do work also with high net worth individuals on individual taxation matters and charitable giving and that sort of thing as well.
So let's jump right in. What are the benefits of gifting? We generally see family gifting in our practice, but there are gifts outside of immediate family members.
That's true. So gifting, of course, comes from the heart, from the folks that want to be able to share their wealth with others, primarily family members, although occasionally you'll see folks who would like to reward other people in their lives. And from a tax perspective, when we get involved, it's usually because the gifting is seen as a form of wealth transfer from one generation to the other. That's the most typical scenario that we see. And people do often have questions about what type of taxable event that might be.
Are there limitations to the amount that can be gifted in any one year?
There are some limitations. There are two kinds of gifts that are unlimited. Those would be gifts directly to an educational institution on behalf of a family member or friend, or the same with medical expenses, so the payment of insurance premiums or doctor visits, whatever type of health care, as long as the payment is made directly to the provider, those gifts are unlimited and don't require any reporting. Other types of gifting do require or may require reporting. If the amount given is less than the current annual exclusion amount, which in 2025 is $19,000, gifts under that amount also don't need to be reported, no matter what they're given for or to whom. But if a gift is valued at more than that annual amount, which does change every year, then they do have to be reported to the IRS on a gift tax return.
So you mentioned a gift tax return. Do you have to pay tax when you make a gift?
So typically the answer to that is no. That name of that form does lead people astray and leads them to think perhaps there is tax involved. But tax is very rarely imposed on those gifts, only when they get to a much higher level than is typical.
What about the recipient? Do they have to pay tax on the gift that they're receiving?
Not at all. It's just a gift.
Well, that's a fabulous benefit.
It is.
What about a gift of property like a house?
So gifts of anything other than cash are allowed, and pretty much a gift of anything is allowed, but it does have to be valued. It has to be valued as of the date of the gift. And so if, for instance, a family member wants to give their child a house, it either needs to be appraised or some other, tax-assessed value can be used sometimes, or the gift, for instance, of a business interest, which we see commonly in wealthy families. Those types of assets do have to be properly valued by a professional in order to report the gift to the IRS.
So we've talked about reporting. How do you actually report gifts to the IRS?
So if there are reportable gifts, those that are over the $19,000 that we talked about, then that's where you probably need to get a CPA involved. The gift tax return is Form 709. And again, usually there's no tax to pay, but it is an important informational report that needs to go to the IRS.
And you certainly want it to be right. So that's why we recommend getting a CPA involved.
Yes, that's exactly right. And these gift tax returns are unusual in another way, which is that they are cumulative over a taxpayer's lifetime. So they are something that has to be kept track of year after year because they affect the ultimate estate tax at the death of the taxpayer. So they are a very important step in keeping track of one's assets during lifetime.
So tell me a little bit more about the estate tax and how gifting plays into that.
That's a great question. So the estate tax, which many people refer to commonly as the death tax, is a tax that is imposed on the total value of the assets when a person dies. The current estate tax exemption, again, here in 2025, is very close to $14 million. This means that most taxpayers are not going to be subject to the estate tax because their assets, the value of everything they own at their date of death, is very likely less than $14 million. But for those whose assets exceed that amount, an estate tax is imposed at 40%. Again, that's today's rate, 40% of all those assets over the $14 million. And the way that gifting plays into this is that lifetime gifts that are reported on this Form 709 to the IRS reduce that $14 million. So in essence, the estate exemption is really the gift exemption as well, and any gift that you make eats into that amount and reduces the exemption remaining at the taxpayer's death.
What other methods of gifting can a taxpayer utilize?
So today we've talked about the simplest forms of gifting. There are some more complex forms of gifting that include family loans. This is actually somewhat commonly used, where parents may want to loan their children money to either purchase a new house or start a new venture. That can be done as a loan, which over time is forgiven, which is treated as a gift, but is a way to transfer wealth and encourage the type of, entrepreneurship perhaps that the child is interested in. Then beyond that, there are some other more complex types of gifting, gifts held in trusts or gifts that are partially charitable, but also bring a benefit to the surviving family members. Those all require much more extensive planning and use of a CPA and attorney.
Thank you so much, Helene. This was very helpful.
You're welcome, Clarissa. It was a pleasure. So, Clarissa, I'm curious, who's going to be your next guest on the podcast?
Well, it depends.